Under multi-asset funds, we can divide them into three categories in general. We have balanced funds, allocation funds, and target date funds. These are typically all some mix of stocks and bonds, like a 40-60 or an 80-20, and many of them are home biased and sensitive primarily to equity and interest rate risks. You've probably seen the stat that a 60-40 portfolio actually has 90% of its risk allocated to the equity risk and only 10% in the interest rate risk from the bonds. So the 5100 ones were right. We have 2500 target date funds, 2000 allocation, and 500 world allocation. So here's where you have to ask yourself, how do you even think to allocate or to evaluate all of these different strategies when you have 5100 funds that are possible to look at? So we're going to get a little more into some of the ways that we as a firm and I would approach this problem. With these traditionally allocated portfolios, you can have large drawdowns during an equity market crisis. You can see that historically, over the full time period from 1871 to today, a 60-40 had a drawdown of 61%. So when you think about a 61% drawdown, does that make you think of something that's diversified and multi-asset? Over the past 10 years, it's been a little lower at 27%. But we haven't had every market environment over the past 10 years. We've been in a bull market for most of it, even though there was 2008. So we ask ourselves, is there a better way to do multi-asset? The traditional approach is really hit by these low forecasted returns that we've seen for equities and for bonds. So we can diversify globally. We saw that global equities like emerging markets and foreign developed would help, but they still lead us to have that high drawdown risk that we saw on the previous slide. So we really need to think beyond this stock and bond mentality. Before we continue, I'll give my next two-digit number, and that's 11. That was 11. Okay, so we've seen the outlook for traditional portfolios, and we've seen some reasons why you might want to include multi-asset solutions. Now we're going to look at how you evaluate these multi-asset strategies. Some of the questions that we focus on when we're looking at this at Newfound is, what's the investment universe? How is it truly diversified? And what happens during a crisis when typically correlations go to 1? How flexible is the strategy? Can it move to one asset class, or does it remain fully invested, or is it going to be able to move to cash? And then how are you going to use it within a portfolio? Is it going to be a core or a satellite? Are you looking for opportunity or risk management? This really comes into play, especially with client framing, for how a client is going to incorporate this strategy in their portfolio and interpret it within the overall context. So the driving principle behind this analysis is not all multi-asset strategies are diversified. And the reason I have multi-asset in quotes is because all of these strategies that we're going to look at are called multi-asset strategies in their name of the fund. So in the study, we looked at 54 different funds with the name multi-asset in their name. And they fell into 11 different categories on Morningstar. You can see that we had the allocation to equity that we saw before, things like large growth, but then things like managed futures, multi-alternative, multi-sector bond, tactical allocation, world allocation. So very different categories on Morningstar for the same named fund. The first lens that we'll look at is we'll check out what the risk and returns of these funds are. So here on the y-axis, we have the 5-year return and the volatility on the x-axis. And they're basically spread all over the place. You have volatility as low as 2% down here, and as high as almost 12, which is in line with the ACWI and SPY, the main equity ETFs. But then you have returns that are up to 10% and down at as low as 0. So these are very different funds, even though they're all called multi-asset. The next lens that we look at is we'll look at what the holdings are. We'll look at some statistics about how much U.S. equity and non-U.S. equity, or U.S. bond and non-U.S. bond, these funds hold. You get a big range. You can see for U.S. equity, some of these funds are short and some are nearly 80%. Same for U.S. bond. Some are short and some have almost 100% allocation to bond. And then we have this other category where it's anything that's not classified as these other four, and you only have funds going up to 12% or 22%, sorry. So there's not much exposure to things that aren't classified as equity or bond. So what do we truly want in a multi-asset strategy? My answer would be some diversification. And if that's your answer, then a good way to look at that is to look under the hood, past performance, past allocations, into the risk factor exposure of the strategy. So we can break out risk factors into equities, interest rates, credit, currency, and other, which includes things like oil, gold, and really anything not captured by these other four risk factors. And we can look at the different allocations or sensitivities to these risk factors rather than allocations. We find that it's as varied as the asset class exposure. For equity risk, the minimum exposure that any of the funds had was 0, and there were 6 funds that had no exposure to equities. The maximum was 91%. Over here, we had one fund that was exposed to 100% residual risk. So it was all idiosyncratic to equity, rates, credit, and currency. And there were no funds that had 0 exposure to a residual risk. When I look at this graph, what I want to see in a multi-asset strategy generally is balance between the risk factors. If something is concentrated in one risk factor, it may be multi-asset, but it's not multi-risk. You may be okay with that. If you're looking for an equity-based multi-asset strategy, having 100% exposure to the equity risk factor might be good. However, if we're focusing on diversification, we really want to see a more equal exposure across the board. So now for a little econometric tool. If we want to see balance in these allocations, we can measure it by something called the Gini score, which is typically used for looking at wealth distributions over a population. The Gini score really quickly ranges from 0, which means it is essentially an equal weight to all the different allocations, up to 1, which means that it's concentrated in one allocation. Anything in between has varying degrees, like 0.75 is 2 exposures, 0.5 would be 3, 0.25 would be 4, but then also it's not quite unique. You can have a Gini score of 0.5, but have 50% allocation or 60% allocation to one thing and 10% to 4 others. So it's really just a tool to see how diversified something is as a rule of thumb. We can graph each of the 54 funds based on their Gini score to these risk factors, and we find that the average is 0.71, which falls right here, but some are concentrated in one risk factor, and we really only have a few funds down here that are more diversified, where they have exposure more equally to 3, 4, and not obviously not quite 5 of those risk factors. So now that we have some tools to evaluate a multi-asset strategy, let's look at 2 examples, and let's look at them in the context of how you would go about designing these, because that can lead you to a better understanding of how you would fit them in your portfolio and how you would evaluate them. Keep in mind that we want a diversified multi-asset strategy. So the 4 steps that we typically use to evaluate something that's multi-asset, we're going to look at it in the context of income generation first. The first step is define the investment universe. 2 is assess the need for being dynamic. 3 is investigate how risk is managed. And 4 is evaluate the implementation details.